They chose to act while you were resting. It's an ancient strategy, one lacking true courage, yet undeniably effective. Last night, as New York slumbered and London brewed its morning coffee, influential entities deployed their most formidable asset. They didn't engage in selling precious metals, nor did they announce new mining operations, nor did they mend broken supply routes. Instead, they altered the very fabric of the market. If you awoke this morning, glanced at your device, and observed a sea of red figures, if you witnessed silver's price plummet from its peaks and felt that familiar knot of dread, that unsettling sense of déjà vu, pause. Take a breath. Because what you're witnessing isn't a market collapse. It's a desperate gambit. The exchange, the institution that purports to be an impartial judge of value, intervened overnight, escalating the margin demands for silver futures they made holding a position 50% costlier than it was just yesterday. Their objective was to force liquidation, to instigate a cascade of sell-offs. Their aim was to crush your resolve before the weekend. But here's the revelation they likely didn't anticipate. Here's the data point that should send shivers down JP Morgan's spine and bring a smile to the face of anyone holding physical bullion. It didn't achieve its intended outcome. In 2011, when a similar maneuver was executed, the price plummeted by 30% within a week. In 1980, when this tactic was employed, the price collapsed by 50%. Today, the price merely faltered, dipped momentarily, and then held its ground. In this in-depth examination, I will meticulously unveil the nature of a margin escalation. I will demonstrate the historical playbook they are resurrecting, mirroring the events of the 2011 downturn with uncanny precision. And I will definitively prove, utilizing the trading volume data from this very morning, that sophisticated investors did not divest their holdings during the dip. They absorbed it entirely. The financial institutions unleashed their silver bullet, yet the formidable force remains undeterred. This is the chronicle of Friday's confrontation. To grasp the reason behind today's downturn, one must first comprehend the speculative arena that is the commodities market. Most individuals believe silver's price is determined by simple transactions. This is a misconception. Its valuation is dictated by speculators trading in futures contracts. These instruments are characterized by substantial leverage. Until yesterday, to control 5,000 ounces of silver, you wouldn't have needed $300,000. A mere performance bond or margin of approximately $12,000 was sufficient. This represents a leverage ratio of roughly 25-1. This mechanism empowers hedge funds, short-term traders, and algorithmic systems to wager vast sums with minimal upfront capital. This leverage is the engine that propels prices upward. However, it also serves as the critical off switch controlled by the exchange. Here's what transpired overnight. The CME Group issued a directive increasing the margin requirement. Let's assume they raised it from $12,000 to $18,000 per contract. On the surface, this may not seem significant, but consider a hedge fund managing 1,000 contracts. Yesterday, they required $12 million in deposited capital. Today at 2 in the morning, the exchange mandates an additional $6 million. You have 1 hour to transfer $6 million, or your position will be liquidated. Where does one procure $6 million at 2 in the morning? It's practically impossible. Consequently, the exchange's automated systems execute the sale of your silver contracts at the prevailing market price to cover the deficit. This initiates a wave of artificial selling pressure. This isn't driven by the fund's volition, nor by any shift in fundamental economic indicators. It's a direct consequence of the house altering the entry cost. This is the essence of a margin escalation. Its purpose is to dislodge speculative investors who are excessively leveraged. Their forced sales precipitate a price decline. As the price falls, others succumb to panic and sell, triggering a chain reaction. This was precisely the intended outcome. This is what occurred in May of 2011. Margins were increased 5 times over 9 days, elevating the cost of speculating on silver by 84%. This action decimated demand, causing silver's price to plummet from $49 to $33. They are employing the identical strategy today. They observe the breakout above $60, the depletion of available silver reserves, and the financial strain on entities like Bank of America, and they pulled the lever, increase margins. However, this time, the results have been markedly different. Why? Because the entities acquiring silver for future delivery in 2025 are not speculators relying on 25-to-1 leverage. They are industrial consumers and national governments making outright cash purchases. Tesla, for instance, does not procure silver using margin financing. The Indian government does not acquire silver on margin, they pay in full. Therefore, when the exchange increases margin requirements, those with substantial physical holdings are unfazed. They do not face liquidation. This explains why the price receded by mere cents rather than dollars. The margin escalation primarily impacts paper-based speculators. It has no bearing on physical buyers. And today, the market unequivocally demonstrated that physical buyers now dictate the terms. Let us journey back in time. If one lacks historical context, today's red candle could induce unwarranted apprehension and prompt a premature sale of holdings. The date was Sunday, May 1st, 2011. The news of Osama bin Laden's demise had just broken, creating a volatile news cycle. Silver had recently touched $49.50, marking a parabolic ascent. Euphoria permeated the market. Then, under the veil of night, the CME Group announced a margin increase. They raised the maintenance margin by 13%. On Monday, silver dropped $5. The following day, they enacted another increase. By Wednesday, margins had been raised 5 separate times. This relentless pressure coerced the market into submission, compelling the liquidation of billions of dollars in long positions. It was successful. The price cratered, ushering in a prolonged bear market that persisted for years. The financial institutions are banking on your recollection of that event. They anticipate that upon viewing today's chart, you will recall 2011 and conclude, the opportunity has passed. I must sell before a significant decline. They are weaponizing your past anxieties. However, examine today's chart more closely. In 2011, the price drop was precipitous, a 10% fall within a single day. Today, the decline is less than 1%. We are witnessing consolidation. What accounts for this disparity? In 2011, the price surge was fueled by paper-driven demand, primarily from hedge funds acquiring futures contracts and SLV options. There was no scarcity of physical silver at that time. The vaults were replete. Consequently, when paper demand was extinguished, the price collapsed. In 2025, the price appreciation is propelled by the depletion of physical reserves. We are facing a deficit of 1.1 billion ounces and the vaults are depleted. Refineries have ceased operations. You can implement margin increases on paper contracts ad infinitum, but this will not generate physical silver, nor will it assist companies like Samsung in manufacturing solar panels, nor will it replenish the LBMA vaults. The margin escalation is a paper-based weapon deployed in a paper-based conflict, yet we are engaged in a physical struggle, and you cannot overcome a tangible shortage with abstract regulatory measures. The market's ability to absorb this shock today is the most bullish indicator I have ever observed. It signifies that the paper market has become largely irrelevant. The physical market, upon assessing the margin hike, simply shrugged and continued its purchasing activity. Therefore, if the margin escalation failed to precipitate a market crash, what did it truly accomplish? It engineered a bear trap. A bear trap is a market phenomenon wherein the price is deliberately driven lower to induce traders to sell, only to rebound sharply, ensnaring those who sold. Consider the psychological state of the average retail trader today. They observe the news of the exchange increasing margins. They witness the price dipping below $64. They conclude that the peak has been reached and that regulatory intervention is imminent. They decide it's prudent to sell now and perhaps even short the market to profit from the decline. Consequently, this individual liquidates their silver holdings. They might even initiate a short position, anticipating a price drop to $50. But who is on the other side of this transaction? Who acquired the silver at $63.80? Was it another retail investor? Unlikely. Retail investors typically panic during periods of price decline. It was an algorithm, an industrial purchaser, or a sovereign wealth fund. These entities maintained their limit buy orders, patiently awaiting the margin escalation to trigger a sell-off. They understood that the less committed investors would divest, and they were positioned to acquire these assets at a favorable price. This creates a springboard effect. The market has now effectively purged speculative, over-leveraged traders. Ownership has transitioned from those with fragile resolve to those with unwavering commitment. The individuals holding silver tonight are not the ones who succumb to fear over a margin increase. They are the ones committed to long-term holding. This action solidifies the price floor. And what of the individual who initiated a short position when the price reverses on Monday? When it surges to $65, they will be trapped. They will be compelled to repurchase their short position at a loss. Their buying activity will further fuel the upward momentum. The margin escalation did not derail the rally. It merely reloaded the weapon. It cleared out excessive leverage, paving the way for a more sustainable ascent. We are establishing a foundational price level, and a base built on tangible demand is infinitely more robust than a temporary spike driven by speculative trading. This brings us to the inherent risk associated with the weekend. Why are financial institutions so intensely focused on suppressing the price today, specifically on a Friday? Because they harbor a profound fear of the weekend. In our interconnected global economy, weekends represent a period when Western market influence wanes and Eastern market dynamics come to the fore. The commodities market closes on Friday afternoon. For 48 hours, market manipulators are unable to directly influence prices. Yet, the world continues its operations, news unfolds, transactions occur, and crucially, markets in the Middle East and Asia commence trading on Sunday evening. If silver concludes the week at a new all-time high, it sends a powerful signal to China and India. The West has relinquished its grip on pricing. This could precipitate a significant price gap upwards when trading resumes on Sunday. The banks are acutely aware of this. Their desperate objective is to manipulate the market's appearance. They desire the weekly chart to project weakness, to display a red candle or a prolonged wick suggesting exhaustion. Their aim is to psychologically manage market sentiment leading into the weekend closure. However, herein lies the peril for them. By artificially suppressing the price today, by employing the margin escalation to contain it, they are, in effect, signaling a clearance sale on silver just prior to the Asian market opening. China observes the margin hike. They recognize it as a symptom of instability within the Western financial system. Do you genuinely believe China is intimidated by a CME margin increase? No. They perceive it as the West depleting its silver reserves and resorting to artifice. Consequently, Monday morning presents a precarious situation for short sellers. If Asia interprets this action correctly as a failed attempt to crash the price, they will aggressively enter the market at the opening. They will capitalize on the liquidity that the West has inadvertently injected. This is precisely why one should never, under any circumstances, sell physical silver during a Friday pullback. You are essentially selling into a deliberately manipulated dip just before the genuine market has an opportunity to react. You are relinquishing your position to those actively attempting to instill fear. The weekend approaches, and in the context of a resource-driven economy, weekends are when supply lines are redefined. For those just joining us, allow me to provide a concise overview of the situation. Last night, the CME Group elevated the margin requirements for silver futures by 50%. Historically, this action represents the ultimate resort. In 2011, this precise maneuver resulted in a 30% market collapse within days. Yet today, silver remains at $64 with a negligible decline of less than 1%. The nuclear option proved to be a mere firecracker. We have established that a bear trap has been meticulously laid. We have confirmed that the banks are exerting considerable effort to paint the market red before the weekend. However, our inquiry must delve deeper. We must examine the divergence. While the paper price is being managed on the commodities exchange, an entirely different reality is unfolding in the physical world. I will reveal the intricacies of the shadow order book. I will elucidate why the demand from industrial sectors constitutes an almost inexhaustible reservoir of capital, and I will demonstrate why this unsuccessful margin hike serves as a definitive green light. The rules of engagement have been rewritten, but not to the advantage of the banks. They have been rewritten to favor those who possess the actual assets. Let us conclude this investigation. Why did the price not collapse today? This is the million-dollar question. If speculators were compelled to sell due to the margin increase, who acquired their contracts? Typically, when speculators divest, the price experiences a freefall until it finds a bottom. However, today, on every occasion, the price dipped to $63.50. It immediately rebounded to $64. It was akin to striking a solid concrete barrier. That barrier represents the shadow order book. In the stock market, level 2 data provides transparency. In the realm of physical commodities, actual transactions are conducted over the counter through private negotiations between major corporations and bullion banks. Here's what is currently transpiring behind the scenes. Procurement managers at major corporations such as Samsung, First Solar, and Tesla have pre-established standing orders. These are automated directives communicated to their bullion banks. They function as follows. If silver falls below $64, acquire 1 million ounces immediately. If silver drops below $63, purchase 2 million ounces. What motivates these standing orders? It's a profound apprehension regarding silver's potential ascent to $100. They perceive today's dip not as a collapse, but as a discounted opportunity. They recognize the fundamental shortage as a tangible reality. Therefore, when the CME escalates margins and compels paper speculators to liquidate, the industrial giants are poised, stating, "Thank you, we will gladly accept." This signifies a transfer of ownership from those with fragile holdings to those with enduring conviction. A speculator buys silver with the intent of selling it for a profit in the near future. Samsung, conversely, purchases silver to incorporate it into circuit boards, a permanent application. Once Samsung acquires it, that silver is permanently removed from the market's circulation. This is the underlying reason for the rising price floor. The available supply, the silver accessible for trading, diminishes with each price dip. The banks, through their actions, are inadvertently accelerating the industrial sector's depletion of reserves by creating artificial price declines. They are facilitating the accumulation of cheaper metal by major players. Consequently, when you observe the price chart resisting a breakdown, you are witnessing the formidable strength of industrial demand. It is an inelastic wall of purchasing power that effortlessly absorbs paper-based market manipulation. So, the margin escalation failed. What is the exchange's next course of action? Their options are dwindling. This is where the situation becomes precarious. If raising margins fails to curb the price increase and if supply is genuinely constrained, regulators are left with only two potential maneuvers. Maneuver 1. Position limits. They will announce a cap on the number of contracts any single entity can hold, ostensibly to prevent market cornering, but in reality targeting ETFs and family offices accumulating substantial silver holdings. This will force them to reduce their positions, thereby generating selling pressure. Maneuver 2. Liquidation-only mode. This is the ultimate contingency, the most extreme measure. They could declare that for the subsequent 30 days, only selling of contracts will be permitted. No new purchases will be allowed. This effectively disables the buy button. If no one can purchase, the price can only decline or remain stagnant. If they implement this, the paper price will undoubtedly plummet, potentially reaching $50 or even $40 on paper. However, here's the critical caveat. If the buy button is deactivated on the commodities exchanges, the buyers do not vanish. They simply redirect their activity. They will shift their focus to the Shanghai Gold Exchange, to the London over-the-counter market, and to the network of physical bullion dealers. This will accelerate the process of decoupling. You will witness paper silver trading at $40 because no one is permitted to buy, while physical silver commands $90 because everyone desires it. The spread between these two prices would reach $50. This scenario would effectively obliterate the commodities exchanges. If the exchange price is $40 and actual silver is $90, no mining operation will sell their output to the exchange. Why would they? They will sell to Shanghai for $90. The commodities exchange vaults will be depleted to absolute zero within weeks. The exchange will transform into a phantom market, trading ethereal paper representations devoid of tangible metal. Therefore, the regulators are in a state of strategic paralysis. If they allow the market to operate freely, prices will ascend to $100. If they engage in excessive manipulation, they risk destroying the exchange itself and forfeiting their control over global pricing altogether. They are in an untenable situation, regardless of their chosen path. This is precisely why the failure of today's margin escalation is of such profound significance. It demonstrates their diminishing capacity to influence the market without triggering a catastrophic implosion of their own speculative arena. Let us step back from the intricate charts and consider the underlying reasons for our current predicament. Why are you holding silver? Is it for the sole purpose of accumulating more dollars, or is it because you recognize the inherent fragility of the dollar itself? Today's market activities, the manipulation, the margin hikes, the erratic price swings, are merely distractions. They are the death throes of a decaying system. The fundamental realities remain immutable. Firstly, the geological constraints. We are facing a diminishing supply of mineral silver with declining ore grades. Secondly, the energy transition. The construction of our future is intrinsically reliant on silver. Thirdly, the escalating debt. The global financial system is teetering on the brink of insolvency, necessitating continuous currency issuance. When you physically hold silver, you possess a claim on the Earth's tangible resources. When you hold a paper contract, you possess a claim on a bankrupt institution. The events of the past 24 hours serve as irrefutable evidence that the paper-based financial system is rapidly divorcing itself from reality. The paper system attempts to portray silver as a risky asset, urging you to sell. The physical reality, however, underscores silver's indispensable nature, advocating for acquisition. You must determine which reality you choose to inhabit. If you subscribe to the paper-based reality, today's events will evoke fear. If you embrace the physical reality, today's events present an opportunity for purchase. The margin escalation was a crucial test. It was a test of your resolve. Did you succumb to panic and sell? Or did you view the price dip as a temporary discount on genuine value? The financial institutions are gambling on your perceived weakness. They are betting on your impatience. They are convinced that you will exchange your tangible assets for their promissory paper. Do not grant them this satisfaction. So what can we anticipate on Monday? Based on the available data, I will venture a prediction. Because the margin escalation failed to trigger a market collapse, and because the dip was readily absorbed by industrial entities, the market is now primed for significant upward movement, much like a coiled spring. Short sellers who increased their positions today find themselves in a precarious situation. They are holding short positions at $63.50, while the current price stands at $64.09. They are already operating at a loss. Throughout the weekend, narratives concerning the physical shortage will gain traction. News regarding halted refinery operations will penetrate mainstream media. Individuals attempting to purchase silver online will encounter unavailability. This will foster a sense of panic over the 48-hour market closure. When the Asian markets reopen on Sunday evening and the U.S. markets commence trading on Monday morning, there will be a concerted effort to re-enter the market. Short sellers will be compelled to cover their positions frantically. Capital that was on the sidelines will rush in. I anticipate a significant price gap upwards on Monday. We could open at $65 or $66. If this occurs, it will leave short sellers trapped with no viable exit strategy short of driving the price even higher. Today's bear trap served as the essential prelude to the next explosive price movement. It purged weak hands, consolidated the price, and definitively established a robust price floor. The trajectory towards $70 and subsequently $80 is now clear. The banks unleashed their most potent weapon, and it proved ineffective. Friday, December 12, 2025. We have weathered the margin escalation. We have withstood the empire's counteroffensive. If you are in possession of physical silver, approach this weekend with a sense of tranquility. You own an asset that the world fundamentally requires and cannot artificially create. You possess an asset that instills trepidation in the financial institutions. Do not allow the volatility inherent in the electronic pricing system to disrupt your peace. 1 ounce remains precisely 1 ounce, and the value of that ounce is progressively increasing each day, irrespective of the CME's digital calculations. The dynamics of the market have fundamentally shifted. The era of their ability to arbitrarily suppress prices has concluded. The new paradigm is predicated on physical scarcity, and in a world defined by scarcity, dominion rests with those who control the tangible assets. Enjoy your weekend. Disregard the fear, uncertainty, and doubt. Maintain your holdings. Remain steadfast. And I will see you on the other side of this anticipated surge. Subscribe.